I'm Bridget Stomberg.
And I'm Lisa D. Simone.
And this is Taxes for the Masses.
Today's episode is on the Qualified Small Business Stock Exclusion, or QSBS.
The Qualified Small Business Stock Exclusion, found in Internal Revenue Code Section 1202, is a tax incentive designed to encourage investment in small businesses by allowing investors to avoid tax on a substantial portion of any gain they realize from the sale of qualified small business stock. In today's episode, we discuss the tax provision and how it was changed recently by the One Big Beautiful Bill.
Hello, B.
Hello, Lisa.
We're taking a little break from some of the craziness in the tax world recently.
Okay.
And the world in general.
Thank you.
And we're going to talk about a classic tax provision that's been around for a while.
Ooh.
Section 1202.
I'm going to tell you that off the top of my head, without having researched this, would not have been able to tell you what Section 1202 is about.
No, me either.
Now, but here's what I tell my students.
Yeah.
Because it had a 12 in front of it, I know it has to do with property transactions.
Oh, that's impressive.
That's all I got.
Yeah.
Okay. The code is organized in a logical way, people.
It is.
So 1202, by all accounts, should be a pretty tame code section.
Okay.
Don't think there should be anything too crazy. I'd say the craziest thing about this code section maybe is the acronym QSBS.
There's BS in there. You gotta love that.
I mean, there is, but it's you gotta pause. That doesn't quite roll off the tongue like some of the other things that we've discussed here on the pod.
I mean, guilty is one of the best.
Right?
Ever.
It's no guilty.
Yeah.
It's no beat.
Yeah.
So fun fact.
Okay.
I am trying to embrace more AI in my daily life.
Okay, why?
The kids.
Okay.
Sigma. I don't know.
Okay, good answer.
So I figured this is a very distinct acronym. And so I thought, ChatGPT, help me get some nerdy ideas of what else QSBS could stand for.
Okay, I'm feeling like we need to find you a hobby.
This is my hobby.
I feel like we need to find you a better hobby.
This is my hobby. All right, probably. But anyway, I enjoyed this little exercise. So one of the suggestions was qualified stock, but suspicious.
I like that.
And the tagline was, quote, for when the 1202 exclusion feels just a little too magical.
Ooh.
Right?
That was pretty good.
Yeah.
Yeah.
Now, in fairness, I do have my profile set up to have ChatGPT act like a tax nerd when I ask it questions.
Okay, that makes sense.
But anyway, it was good.
Okay, so we definitely need to get you a hobby.
Disagree.
That's going to be for another day, though. Today, we have two goals. So first, we're going to discuss the mechanics of this code section and how it operates to save taxpayers cash money. Mm-hmm. Then we'll move on to a brief discussion of how the provision was changed by the One Big Beautiful Bill, or as we have decided to call it,
yes,
OB3.
OB3. Got to get used to it, listeners.
Ready, Freddie?
I am ready. All right, so Code Section 1202 is a taxpayer-friendly code section. Turns out that they're not all taxpayer-friendly.
No,
some of them are anti-taxpayer, but this is taxpayer-friendly. Why? Because in certain circumstances, it allows individual taxpayers to avoid paying income tax on up to 100% of any gain they realize on the sale of stock.
That does sound magical.
It does.
And suspicious.
Yes, a little too magical.
So you might ask, why would Congress propose such a magical provision? Well, this first became law in 1993, and the goal was to use tax policy to incentivize investors to put money into, quote, small and developing businesses. And the potential tax savings are pretty big when you consider that the top capital gains tax rate is 20% plus a 3.8% net investment income tax.
Can't forget that.
And anytime you tell me that there's potential to avoid a 23.8% income tax liability, I know, first of all, I'm listening.
You're excited.
I'm excited. But I also am wondering, what hoops do I have to jump through to get this?
That's a good intuition, because you're right, there are hoops. So just a bit of additional history here. In 1993, when the law was passed, the top capital gains tax rate was actually 28%.
Okay.
So yeah, the tax benefits are big now, but they were even bigger 30 years ago when the law was initially passed.
Take that, OB3.
So first, let's talk about the details. We need an eligible shareholder.
Oh.
we need them holding eligible stock.
Okay.
And we need them holding that stock for a certain period of time. So 3 hoops.
Three
You gotta be an
hoops.
eligible taxpayer, eligible stock, certain time period.
Okay, let's tackle them one at a time. So, eligible shareholder, generally speaking, is any shareholder other than a C corporation. So, this could be an individual, could be a trust, could be an estate.
Yes.
Partnerships and S corps can also qualify, but they have some additional requirements. And we're really just going to focus on individual shareholders today. That's what we care about.
Fair enough. So to be eligible, not a C corp. Now we need that individual to hold, quote, eligible stock, or said differently, they need to hold stock in an eligible corporation. To be eligible, a corporation must be domestic, so a U.S. domiciled corporation. And that has to be the case when the corporation first issued the stock and for most of the time that the individual was an investor. The corporation also must be, you guessed it, small. Because remember, one of the S's in QSBS stands for small. So tell us, Lisa, what does small mean in this context?
It means that the corporation's tax basis in its own assets cannot exceed $50 million at the time of the issuance of stock.
Okay.
And that's an important point because the whole idea here is that you want to invest in a small company that grows so that you can cash out for, that cash money. So the company's assets can eventually exceed 50 million.
Correct.
And that's what you hope is going to happen.
Correct.
And it can still be considered a qualified small business stock eligible for this exclusion as long as at the time the stock was issued, the company had less than 50 million in assets.
Okay, so the corporation has to be domestic, has to be small. We're talking mostly about individuals here. Anything else?
Of course, there's something else.
Yes, okay.
Corporation has to be engaged in a qualified trade or business.
Oh, yes, we love this.
Now, some of our sharp-eared listeners, and myself included in that phrase might be triggering.
Yes.
Because to me, it conjures up the qualified business income deduction, which is a true horror show of hoops to jump through.
Absolutely, and I am triggered.
Okay, me too. In this case, a qualified business, generally speaking, is one that produces something. So businesses that primarily offer services like healthcare, legal, accounting, financial firms, these are not going to be qualified small businesses for the exclusion.
No. Now, the trick is that the corporation isn't entirely prohibited from engaging in those types of non-qualified businesses, but at least 80% of the value of the corporation's assets must be used in, quote, the active conduct of one of these trades or businesses.
Okay, so we've got individuals or estates or trusts holding stock in small domestic C corporations. Wasn't there like a timing piece?
Yes, the holding period. To qualify for the exclusion, the investor, so now we're back to talking about the individual owning the shares, they have to hold the stock for more than 5 years before they sell it.
Okay, are there any restrictions on how they acquire the stock in the first place?
Excellent question. In general, to qualify, the stock must be acquired directly from the company at its original issuance. And that makes sense because we said it had to be domestic at the issuance. It had to have only $50 million of assets at issuance. So the provision is targeted at individuals who are investing, again, in small businesses, not people who jump on the bandwagon later on. So if you purchase stock from another taxpayer, it's not going to qualify.
And you just said startup. So what about stock that's received as compensation? Because we know a lot of startups pay their employees with a high percentage of stock because it's cashless and they need the cash for the business.
So that's another excellent question. And yes, thankfully, stock received as compensation for services to that qualified corporation also counts, as does stock received through a gift or inheritance, as long as the giver originally purchased the stock directly from the corporation.
That was a lot. I need a quick stop. Back soon.
I see what you did there. Well done.
Thank you.
All right, so we've outlined the requirements for Section 1202, the qualified small business stock exclusion.
But before moving on to our second goal, I think it might be useful to illustrate the benefits of all of this with an example.
Okay, can I do it?
Do it.
All right, so we're going to have two individuals.
Yes.
And we're going to call them Lisette and Brigitte.
Okay.
And they're going to start a business that manufactures cheese and chocolate.
Of course they are.
Qualified trader business.
Of course.
They're making stuff.
Producing things.
In 2017, they each received stock from the corporation, which is called Brie et Bonbon.
Ooh, why haven't we done this?
Right? well, mapping it out right here is our business plan. And they each take a $100,000 adjusted tax basis in the shares. Now, although this sounds very French, I assure you that Brie et Bonbon is a domestic corporation.
Excellent.
And it is also small.
Obviously, the company is going to do amazingly well.
Obviously.
I think it's all the press that the founders got when they were providing goodie bag favors for the Cannes Film Festival.
Ooh, yes, please.
And in 2025, Lisette and Brigitte are able to sell their shares for $8.1 million each.
Well done, ladies.
Money, money. So each of them has an $8 million gain that in general would be taxable.
That is correct. If we ignored or didn't know about good old code section 1202, Lisette and Brigitte would each owe over $1.9 million in federal income taxes. The current top rate of 20%, and we can't forget that pesky net investment income tax of 3.8%. So that's going to leave them each with around $6 million in cash, which isn't too shabby, but I think we can do better.
I mean, I'd take it.
I would too, but I think we can do better. Let's get greedy.
Okay, yes. All right, here's where section 1202 comes in. So Lisette and Brigitte are individuals. Brie et Bonbon is a qualified small business, and the taxpayers have held the shares for more than 5 years, so they can exclude at least some portion of the $8 million gain from taxable income. The question is, how much can they exclude?
And the answer is,
it depends. First, it depends on when the stock was issued. For all stock issued after September 28, 2010, up to 100% of the gain can be excluded. The max exclusion is smaller for older stock that was issued before that time. It goes down to 50% of the gain.
Second, it depends on the size of the gain. Size matters. For stock issued before President Trump signed OB3 into law on July 4th, 2025, the gain exclusion is capped at the greater of $10 million or 10 times the adjusted basis of the stock at the time it was issued. Don't worry, we'll have an example. For stock issued after that effective date of OB3, the gain exclusion cap increases to $15 million or 10 times basis, and this amount will be annually adjusted for inflation, meaning it will likely increase at least by a little bit every year.
Okay, so what does this mean for Lisette and Brigitte? They can exclude up to 100% of the gain because their shares were issued after September 28th, 2010. Okay, now onto the second prong. How much of the $8 million can they exclude? The max they can exclude is the greater of $10 million or 10 times their basis in the stock at the time of issuance because they started their company before July 4th, 2025. For each of them, their basis was $100,000, so they can exclude the greater of $10 million or $1 million, which is 10 times the $100,000 basis, which means they can exclude up to $10 million, which means they can exclude all of their $8 million of gain. I'm going to say that again. None of their gain is taxable, and they save $1.9 million in tax.
Love that.
Yeah.
So sold it for 8.1, zero tax dollars.
Yes.
Okay, but what if, just humor me.
Yeah.
Instead of selling their shares for 8.1 million each, it was 18.1 million each.
Then we each get a house on Lake Austin. We don't have to share one.
I kind of want to share.
Yeah, I know. But then what do we do with the golf carts? Do we need golf carts? Oh, we're going to have like separate compounds? I don't know.
We'll figure it out. We'll figure it out.
Okay. All right. So now each of them has a gain of $18 million. And we just said they can exclude up to a maximum of $10 million. So they will have a taxable gain in this case on just the $8 million above that $10 million exclusion.
Correct.
But there's another wrinkle here.
What?
Yes. Any unexcluded gain now is going to get taxed at a capital gains tax rate of 28% instead of the top rate of 20%.
Stop.
And you can't forget about that pesky 3.8% net investment income tax. But again, they're saving $2.38 million of tax on the $10 million of excluded gain.
Fair enough.
Which more than offsets the higher tax rate on the unexcluded $8 million gain.
Okay.
It's also worth noting that the $10 million cap is an aggregate per taxpayer. So if Lisette and Brigitte sold other shares in the future, they would have exhausted their $10 million cap and all subsequent exclusions would be limited to 10 times their basis.
That's right. And that actually raises a really important planning tip.
Tell me.
So taxpayers should always sell their lower basis shares first to make sure they use up that $10 million exclusion first. And then when they sell their higher basis shares, that max cap will be even bigger.
That makes sense. Bottom line is that this provision can be really, really beneficial, but it's also, I'm gonna say, a little complex.
Oh, yeah.
And there are some things that people need to be aware of before selling any of their qualified small business stock.
Okay, so we understand how it works. We talked a little bit about the new rules under the OB3, but let's just recap that one more time.
Yeah, good point. Because the OB3 did change this. The exclusion was first introduced, as we said, in 1993, and the definition of what is small back then hasn't changed according to the tax law, but has changed in reality, right? Because inflation happens.
Yes.
So, for example, that $50 million max adjusted tax basis in 1993, inflation adjusted, that would be over $100 million today. So the OB3 came in and expanded those limits and thresholds a little bit to kind of reflect at least a little bit of the reality of inflation since 93.
Yeah, and I always like it when we do that and then we change it so that it's going to get indexed going forward. I think that's just smart.
Yes.
So the new bill does increase the asset limit. It doesn't get it all the way to where it quote unquote should be, but it increases to 75 million, which is helpful. Also indexes it for inflation starting in 2027, which is helpful. And as we mentioned in our example, it increases that $10 million cap to $15 million, and that's also indexed for inflation. So I like all of this.
Yeah, I do too. Another pretty interesting change is to introduce tiered exclusions for shorter holding periods.
Okay, say more things.
Yeah, so what if you don't hold the stock for 5 years?
Okay, so before it was all or nothing.
Yes.
Okay.
You had to hold it for 5 or else you didn't get anything.
Okay.
Now you can get some tax benefit after 3 years, but it's only 50% exclusion and 75% after 4 years. And of course, to get the full 100%, you got to hold it for 5.
Okay, that seems reasonable because it's still incentivizing long-term if we think about long-term as being more than a year-long investment, but it does offer some opportunities for faster exits.
Yeah, agreed. So these changes seem reasonable and logical to me.
Okay, so how are you feeling about things so far?
I feel like we've become a lot smarter about qualified small business stock.
Would you say we've quite suddenly become smarter?
Well done.
Okay, time for the good, the bad, and the ugly. Do you want to kick us off here?
Yeah, I mean, I've wanted to do an episode on qualified small business stock for a while. I talk about it in my tax class that I teach. Students like learning about it. I have some interesting anecdotes from students who have taken advantage of this over the years. Mm-hmm. And I kind of like the changes that have been made. So thank you, OB3, for giving us an opportunity to talk about a pet provision of mine.
Agreed. I don't know that I should be admitting this publicly, and maybe we'll cut it, but I always assign this topic to my students. Like, I have my students do a little 5-minute presentation at the end of every case, like it's an extender of the case. And I always have them present on this, and I just sort of give everybody an A because I didn't really understand the intricacies of it. So I was like, that sounds good. That sounds generally correct. And now I will actually be able to evaluate the accuracy of their responses. So
I feel like we shouldn't cut that. I feel like your students have a right to know.
Everybody got an A. Everybody got an A because I didn't know what I was talking about. Yeah. Bad.
Yeah. Well, it's always puzzled me a little bit that only C corporations qualify as an investment.
Thank you. And I actually remember learning this with you on the dock at the Lake Austin Resort when we first started this podcast. And and jokingly, I said, when we sell this thing for $100 million one day, we're going to get that sweet QSBS deduction. You said, no, ma'am, because we're not a C Corp.
No, we are not. We're an LLC.
We fact checked it and you were correct.
Well, yeah, of course I was.
Of course
correct.
You were. That sucks.
Yeah. It's interesting because most small businesses are organized as partnerships or S corporations, LLCs, whatever, flow through any, not C corporations.
No, yeah. And yes, C corporations, I think, are the least common form of business entity in the U.S. by a mile.
Yeah.
So that makes it a relatively narrow policy that really excludes investors in about 90% of small businesses. And it also omits some businesses, like we said, that aren't qualified. Yeah. So another thing I recently learned, because in my case, the business is providing consulting services, they don't qualify. Mm-hmm. But if they instead were a software provider.
Oh, yeah. Software qualifies.
Then that qualifies. Yep. And so, and there's actually been some court cases distinguishing what is software development versus software consulting. So there really are a lot of intricacies here, maybe making things more complex than they need to be.
And also, why does the tax code always hate accountants and lawyers? I mean, most people do, but why does the tax code have to do it too?
Take a contrarian position. Show us some love.
Yeah.
Okay, anything ugly?
I mean, these benefits are primarily going to startup founders, early stage VC founders, angel investors. Yeah, you got some employees there, but it's primarily going to people who do not need the tax benefit.
Correct. There are actual academic studies that document that the benefits disproportionately accrue to wealthy taxpayers and also to white taxpayers.
Oh, good.
Yeah.
Good.
It's also costly. So we found some estimates to suggest that in its old version, it costs about $2 to $3 billion per year, but it actually turns out that those estimates could be understated. And then I'm imagining you're our estate tax guru. There's got to be some estate tax planning opportunities around this one.
I have heard of some things that people are doing. I don't know about estate taxes, but perhaps this is related to estate taxes too. So I've heard some schemes.
Estate and trust.
Yeah,
maybe is what I'm thinking about. There you go. Trust. Yes.
Yeah. So you can, I'm not going to say you can. Some people have speculated that if you take that stock and you split it out into separate trusts, which are a vehicle for ownership of things where you can designate who owns, who benefits from,
who's legally owns the shares.
The shares. If you split that out, because it's a separate entity from you, there's some speculation that each trust would get its own $10 million exemption.
Or $15 million now under the new law.
Exactly.
Okay.
So you're able to multiply it by the number of trusts you put that stock in. I'm passing this along as an anecdotal scheme. I am not endorsing this scheme. I am not saying it's going to work.
Please consult your tax advisor.
Yes.
But you're right. That does seem like at least a potential tax planning opportunity to really get a multiple on that $10 or $15 million exemption. You take that stock and you either give it to other people or you give it to trusts that you control, and you've really powerfully multiplied that exclusion.
Potentially, yeah.
Okay, so it's costly. Maybe it's accruing to a certain demographic of the population. Is it working? Does it do what it was intended to do, which is increase investment in small businesses?
Well, we're going to turn to some of our colleagues who are researchers, Alex Edwards and Max Totenhaupt. They look at the 2010 change to Section 1202 that increased the exemption to 100% of exclusion.
Okay.
And they find that the provision does lead to increased funding for startups.
Okay.
By as much as 12% in each funding round.
In each round.
Not insignificant.
Okay.
But these benefits are greater for firms with more, quote, administrative capacity.
Okay.
So these are firms with more early stage active investors like VC firms and accelerators. So some might conclude that the exclusion is basically just a tax break to investment that would have happened anyway, because that's what VC firms and accelerators do.
Got it. And that's what you said at the beginning. Most of the benefits are accruing to these types of investors. And here you go.
So not only is it that they don't really need the benefit because they're wealthy individuals and firms, but also this investment may happen even without the incentive.
Correct.
So why are we spending the money to get something that would have occurred anyway?
Correct. So that doesn't sound great. So let's try to be good reviewers here. Let's not just point out the problems with the papers, with the policy. Let's try to provide some suggestions of how to fix it. So what can we do to improve this bad boy?
I mean, you could just get rid of it.
Good, which is the version of a reject. We're just going to reject the policy so we don't have to look at it again.
Okay, fair enough. All right. We could make it more complex by having more qualifiers in there to make sure that it's going to the right people and that it's stimulating the right investment that wouldn't have happened anyway. Are you happy?
Yeah, so either chuck it or get more enforcement, and that would require more money to the IRS, which we're not going to get, so we're back to chuck it.
Yes.
Okay, reject. Strong reject. How you feeling at the end of this episode?
Quite seriously, brain spent.
Love it.
Well, that's all we have time for today.
Be sure to join us for more tax nerdery on future episodes of Taxes for the Masses.